So we'll just go through a couple of buckets here. I mean, some of this can be daunting, trying to keep it as simple and straightforward as possible. But we can definitely, dive in and explore what makes the most sense. But for right now, we'll just keep it, looking at a house, your cars, right? Your boats, whatever you have sitting here. We typically find that a lot of our clients, before they have proper trust structure, they have a lot of things sitting in their personal bucket, or maybe it's in an LLC. But a lot of it's sitting in their personal bucket. And the two penalties that we face when we have things in our personal bucket is we can get sued, so things can be taken from us, and we get taxed. So a little rhyme to remember. The structure you choose dictates the tax code you use. It's only the structure that we're in is why we pay the tax we do. So, tweaking it a little bit. Own nothing, control everything can really do some wonders and be a dynamic shift for the future. So let's take this property, for example. This is you. And, we talked about the living trust for a moment, right? So the living trust actually sits here in our personal estate. What do? We gift, we grant, right? So we still hold the equity of the asset. We are still the owner of the equity. So it can be taken from us, right? So we don't want to grant anything to a trust. We want to sell. Everything's by notarized bill of sale. So we'll take two scenarios. We have a gentleman that's planning on selling this asset, and he's renting this asset and bringing in rental income. So he's selling one and holding on to another for passive income. So let's talk about each scenario. So this asset that he's planning on selling, each asset would be done at book value, right? You're selling it to not impose a tax on yourself. The CPA will help you define what this number is. Typically, it's your cost basis plus improvements minus depreciation equals your book value. So let's just put a number here and say that that number is 500. But now this property is worth $1 million. Well, he sold it to his trust at cost basis. He did not impose a tax on himself. And this has a separate tax ID number. It files its own federal tax return every year. It has rights. And it's a separate legal entity than you. It's not you. So if you sell it to a trust that you did not create, but you are the puppet master of, so you are the trustee of this trust, you work with your real estate agent, it's in a contract, and it's the trust that's the seller, not you. The trust goes out here, close of escrow, and sells it at fair market value. So we'll say it's $1 million. Or there's a trust bank account that gets established. Remember that this trust that we're talking about right here, this is the beneficial trust. Another term, family trust. This is the one that's going to hold all of your assets and all the passive income that those assets produce. Remember, we shared capital gains, rental income, dividends, interest, royalties, and K1 passive. That can all be held here and deferred here. So in the same trust, this individual wants to sell his rental. Say his rental's 800. Okay, great. He's producing rental income and he's making rental income every month. So he sold it to his trust and it goes out every month, makes rental income, and all that money comes into the trust bank account, deferred. So what's fantastic about this is the number one rule of the trust is whatever the trust holds, the trust is responsible to pay for to maintain those assets. So the mortgages, the lights, the water, the landscaping, insurances on the cars and the houses and the boats, the improvements on the rental, everything now can be paid with pre-tax money. So it really puts you in the driver's seat to hold on to more and to deploy more to obtain more. Any questions on what I discussed so far? Okay, great. So I just want to close the loop on this one. Any bills of sale, any contract of selling an asset to your trust creates a demand note. You could do this all aggregated on one bill of sale and have a matrix, right? A list of all of your assets that you're selling and what those dollar amounts are. And you could have one big demand note or multiple. But the whole point is, if we take a look at these two assets that he sold, this is $1.3 million in assets that he sold to the trust. Well, that means it produces a fancy IOU called a demand note. It means that this trust, which is a separate legal entity than them, owes him that 1.3 million on demand, not on an amortization schedule. It's just on demand. It does have an interest rate associated to it, reasonable interest rate, say it's 5-6%. So that will accrue. So when you do take money against your demand note, there'll be small interest that you do declare on your tax return. But being able to sell the asset for asset protection, for tax deferral, holding on to more, but being able to pull against the demand note is a method to pull out a certain amount of money up to your cost basis. And this is most important because you should not pay for your own food, fun, and fashion from your trust. All right, so food, fun, fashion. So pull it from your demand note. Or if you have a spouse that has W-2 income, well, that's coming in here, getting taxed anyway. See if that's enough for your food, fun, fashion, or we can help you back into the numbers and see what makes the most sense. The one other thing I want to explain on this type of trust is it is for the ultimate benefit of the beneficiaries. So when you think of your beneficiaries, like for example, I have my 3 minor children, but I also have my mother and father-in-law who are older, 85, 88 years old. We're paying for a lot more of their medical expenses. We're a business owner. We want to hold on to more. So for my beneficiaries, I'm able to pay for their welfare, their medical expenses, and education. So welfare up to 21 years old, medical for their entire life, and education up to 24 years old. So this is the game changer. When you have all this pre-tax money, you go write that check for medical expenses or write that check to Stanford for tuition. Or for minor children, the food in their belly and the clothes on their back. These are legitimate expenses that the trust is responsible to pay for. And as long as they're coming straight from the trust bank account, it is not a distribution. It is different than if you just wanted to pay your beneficiary, say $100,000 cash. You just wanted to distribute. See, we teach you to put enough mechanisms and contracts in place and teach you on how to utilize those to pull up to, right? Using your demand note for your own food, fun, fashion, pulling out for your beneficiaries for their specific welfare, medical, and education expenses, taking care and maintaining your assets, reinvesting money to buy more assets. All of that is not a distribution. But if you were just to distribute, say it's $100,000 cash straight into your beneficiary's hands, well, that's a distribution. And whoever is receiving that, the recipient is going to pay they're going to have to pay ordinary income tax on what they receive. So again, utilizing the trust, own nothing, control everything, teaching your children to own nothing, control everything, right? You just don't want to give them the cash to put in their own personal bucket, teaching them what to do. Now, I have a few of my older families, more mature families that have those adult children that already have their spouses and their children. Well, they want to leave equal parts. Well, they can choose to do that, and they can set this up where they can waterfall into their own specific trusts when they want to. So they can distribute, but they're distributing again into a trust that's using the complex tax code, which means you're not required to distribute. So that means that these are also using the complex tax code. They're waterfalling in here and continuing to defer. So great strategy for your younger families, your more mature families. Some of us siblings get along, but a lot more don't. So, having a strategy that works for all is most important. Any questions on that?
Yes, April. I have a question with regard to crypto.
Okay.
So one of the common things that people like to do, because it's very cyclical, is to take and when crypto's had a big run, to possibly cash out of that and then reinvest it in something that they think will be a better horse to ride at that time. Maybe it's precious metals or real estate, but it seems like if they're not doing that within a trust, that's creating a taxable income event rather each time, but inside of the trust, you wouldn't have that. Is that correct?
That is absolutely correct, John. That's
Okay.
right. So they would sell it at cost basis to their trust, then be the puppet master of that trust. It's just the account would be held by the trust, ABC Spendthrift Trust. They would still do, right, the trading like they normally do, but that trust is selling that asset. And then all of those capital gains come in deferred, and then they can deploy. And to your point, they don't have to stay in the crypto world. They can go buy another investment.
Right.
But
Seems like,
absolutely, it's
it seems like
wonderful
that's a huge.
for your crypto guys.
Thank you.
Thank you, John. One more area that I just wanted to cover was more on the active income side. On the active income side, we find so many of us business owners were paying 20, 30, 50, 100, 500, $1 million a year in tax. Whatever your number is your number, but it's money you could be holding on to. So if you find that you're paying around $30,000 a year in tax, it may be time to really look and explore more into this strategy because implementing into your life could help you defer so much. And I'll share and I'll go through the dual trust structure. I'm going to bring this, give a little bit more clarity on the simple versus complex. Simple, complex. We use the name business trust, just means that this is the trust that can bring in active income. So you want a place that can gather, right? Active income. So income can come from an LLC, corporation, 1099 income. However you bring that income, it can come in from all different sources and all aggregate here. But again, we'll just keep it simple. And we'll use one structure for today's illustration. Say this is $1 million net. So this business owner operates his LLC just the same, pays his expenses, makes payroll, pays his payroll tax. What we're talking about is the net income at the end of the year. That net income, if he were just to file his business and personal tax returns, he would be paying on his K-1 quite a bit. probably $300,000 in tax. But if he were able to set up this trust structure in the current tax year, he can set up contracts and he can make this business trust a limited partner as an investor. See, it's going to invest. It's an investor. It's a limited partner. It's not owning the LLC, but it does own the net income. So it's a way for you to pool up to 90%. So in this case, that's $900,000 that could be moved into this trust. And now this business owner is only paying tax on 100K, not $1 million. So reducing your taxable liability up to 90% if you're operating an LLC can be a game changer. This one is using this simple tax code, so it can bring in active income. It distributes, right? Simple means it must distribute annually. That's okay. That's exactly what we want it to do. But this is part of the secret sauce. The CPA will make sure to declare this as an extraordinary dividend. Remember that tax code 643, where it says extraordinary dividends are excluded from being considered income as long as it's allocated to corpus. We declare it as an extraordinary dividend. That $900,000 gets moved from here to here, deferred. And that business owner can deploy and use to invest in another business, buy more real estate, pay his mortgage. You could see how this just continues to funnel and continues to grow. It allows you to hold on to so much more. So quite a few of our business owners will do a dual trust structure and operate it in this way. It allows you to hold on so much more. Now, asset protection. If you have this LLC, right, you have your membership interests, you have your shares, you have your intellectual property, tangible and intangible, right? Your trademark, your logo, even your goodwill, your reputation, that all has value, right? Putting a value on that, being able to sell, right? So what would happen is you would sell it here, bill of sale here. Now you have your shares and your IP here. So this does two things. When this LLC gets sued, and it's not if, it's when, we have a little joke that LLC stands for large lawsuit coming. You just have your LLC. The bigger we get, the bigger the target. So when you get sued, if you have moved all of everything of value down here into this trust that has a spendthrift provision, that's non-grantor, that's irrevocable, that has all the ironclad provisions to give you true asset protection, what are they going to take? You don't own anything. You control it all. Opposing counsel only sues entities and people that have money. So great asset protection is moving, right, your assets into the trust that you control. And in the future, when you get ready to sell your business, you have the trust. So 1% is what? The EIN number. 99% is in your shares and your intellectual property and your assets for the business. So this is where you get hit with capital gains. But if you have the trust sell it on your behalf, all those capital gains are deferred. And that business owner that just had their windfall, they didn't walk away from the closing table because that sticker shock of the taxes were so high. They were able to hold on to that and then deploy that into other investments or another business. So a phenomenal strategy that can help you today. It can grow with you for the future. And you can definitely leave so much more to your loved ones and teach them. Own nothing, control everything. Any other questions that I can answer for today?
So the trust has a federal identification number. Does it pay? It has to file taxes every year or no, or?
It does file taxes every year. I mean, it files a tax return. So a federal tax return is filed every year. It does not mean that you're paying tax every year. So everything will be declared as an extraordinary dividend, and extraordinary dividends are not considered taxable.
Okay.
So you would
Gotcha.
not get, right, so there's no tax that the trust would be paying at that time. Any other questions?
So April, can you just clarify again for people like that, how long you can defer these taxes, these capital gains, as long as you keep the trust active?
That's right. You can defer for as long as you would like. It can continue to defer for generations. The spendthrift trust that we can point to, one of the older ones that we found is the Windsor Trust. Windsor Spendthrift Trust. It holds the Windsor Castle. That one's been operating for over 400 years. So you can continue to defer as long as you continue to operate, file the federal tax return that's required every year, and just doing the letter of the law. It can continue and continue and continue. So there is no, oh, wow, I need to do this. I need to recoup this in 20 years or 30 years. This is truly something that you can really build generational wealth and teach your children to continue to defer, right? Teach them to live within that trust structure that you've been operating, not distribute, right? But live within the confines of the trust. It could be a beautiful thing.